This might be the biggest tax bill in years, and whether you're a server, eBay seller, a small business owner, a parent, or retiree, there's something in it for you. The president just signed into law what's being called the One Big Beautiful Bill, and it's packed with sweeping tax changes. 1099-K changes, tax relief on tips and overtime, bigger deductions for seniors and families, and major breaks for business owners. But behind the headlines is a massive $3.4 trillion price tag, and what that could mean for our national debt, the dollar, and your financial future may surprise you. There's a lot of misinformation out there, so in this video, I'll do my best to break it all down, the benefits you could see, the fine print you might miss, and why some of these gifts come with a long-term cost. Let's take a look at what's inside and how it could affect you. Hi, I'm Noel Lorenzana. I'm a CPA who prepares taxes, and this bill just ensured job security for tax professionals like myself and many more for years to come. Thanks to the newly signed law, platforms like PayPal, Venmo, and Cash App will only send you a 1099-K if you have both over $20,000 in payments and more than 200 transactions in a year. So basically, this reverts back to the old rules. This is huge, and this change takes effect for 2025. The IRS had planned to drop the threshold to $5,000 in 2024 and just $600 in 2025. But this new law completely overrides that. So if you're a casual seller, side hustler, or splitting rent with friends, you're off the hook. And yes, this one's real. It's written right into section 70,000 something of the Big Beautiful Bill. You can find it starting on page 443 of the full text. If you earn tips, whether you're a server, hairstylist, or rideshare driver, this is a big deal. Starting in 2025, you can deduct up to $25,000 of tip income each year from your taxable income. You still need to report your total income, but then you can deduct the tips up to that limit on your tax return before calculating your tax. This deduction runs from 2025 through 2028. And no, I know what you're thinking. You can't just decide to classify your earnings as tips. That's not going to work. Same structure here. If you work overtime, you'll be able to deduct up to $12,500 per year in overtime wages. That's money you earn beyond 40 hours a week that the IRS would no longer touch up to that limit. Again, it's a deduction on your tax return when you file your tax return, not a full exclusion, and it also applies for 2025 to 2028. For seniors age 65 and up, the bill increases the standard deduction by an extra $6,000, but it phases out if your income exceeds $75,000 or $150,000 joint. So instead of taking the usual standard deduction, qualifying seniors will get a larger one automatically, starting in 2025 and lasting through 2028. This replaces an earlier idea that would have made Social Security tax-free. Instead, they went with an increase in the standard deduction for seniors. According to Kelly Phillips, the tax girl, under current law, taking into account credits and deductions, 64% of Social Security beneficiaries already do not pay taxes on their benefits. The new deduction will increase that figure to 88%. Here's something new. You'll be able to deduct up to $10,000 a year in car loan interest, but only if your car had final assembly in the United States. There's also an income limit. This deduction phases out for incomes over $100,000 if you're single, or $200,000 if you're married filing jointly. Like the others, this one applies to 2025 through 2028. Another important note, this only applies to vehicles you purchase and finances. Leases don't qualify. This is the cap or limit on state and local tax deductions, what we call SALT. This is getting a major boost. Under the old rules, you could only deduct up to $10,000 of state and local taxes on your tax returns. The new limit is $40,000, up from $10,000, but only for taxpayers with income under $500,000. The higher cap starts in 2025, it stays through 2028, and then gradually phases down by 2029 unless extended. This will help out a lot of people, especially those who typically itemize their deductions before 2018. The child tax credit goes up from $2,000 to $2,200 per child, and this change is permanent under the final bill. The House originally wanted to go up to $2,500 for just 4 years, but the Senate version won out and made it $2,200 forever. So if you have a child under age 17 at the end of the year, you can get a nice bonus here. One change that might catch some folks off guard: if you deduct gambling losses, you'll now be limited to just 90% of your winnings. It used to be 100%. So let's say you win $10,000 gambling this year, but you lost $10,000. You'll only be allowed to deduct up to $9,000, not the full $10,000 like before. My personal opinion, this is just another reason not to gamble. And finally, even if you don't itemize, starting in 2026, you'll be able to deduct charitable giving up to $1,000 if you're single or $2,000 if you're married filing jointly. This deduction is permanent and rewards charitable giving without the complexity of itemizing. In other words, you won't need to itemize your deductions to take advantage of this limited charitable contributions deduction. So just to recap, 1099-K reporting reverts back to the old rules: $20,000 and 200 transactions. We're talking $25,000 tax-free in tips, $12,500 in tax-free overtime, a $6,000 senior deduction boost, $10,000 in car loan interest, a SALT cap that quadruples, and a slightly bigger child tax credit, plus changes to gambling losses and charitable giving. That's a lot packed into one bill, but the business side, let's talk about that next. If you run a business, whether that's a side hustle, you're self-employed, or managing an S-Corp, this bill has two major tax breaks you should know about. These changes are designed to make it easier to grow your business while paying less in taxes. Let's start with bonus depreciation. This provision lets you fully expense qualifying business purchases in the year you buy them instead of depreciating them slowly over, say, 5 to 7 years. That includes things like commercial use vehicles, computers, office equipment, tools and machinery, furniture, fixtures, and even certain property improvements. So if your business spends $40,000 on a new truck or $15,000 on office gear, you can deduct 100% of that cost immediately, reducing your taxable income dollar for dollar. This isn't just nice to have, it's a real cash flow advantage that frees up capital to reinvest in your business sooner and avoid overpaying taxes in the meantime. The Qualified Business Income Deduction, also known as the QBI or Section 199A deduction, is back and more accessible than ever. Here's a quick refresher. If you're a sole proprietor, partnership, or S-Corp owner, the QBI deduction allows you to write off up to 20% of your net business income. So if your business earns $100,000 in profit, you might only pay tax on $80,000. The bottom line, whether you're making $30,000 on a Schedule C or $300,000 through an S-Corp, this deduction helps you keep more of your income in your pocket where it belongs. Just a quick heads up, if you're in a specified service, trade, or business like law, accounting, consulting, or certain health professions, you might still face some income limits that reduce or eliminate the QBI deduction if you earn too much, so it's not automatic for everyone. But if you're under the threshold or if your business is non-service based, this could be one of the most valuable deductions available. Bottom line, the QBI deduction helps you keep more of your earnings, and this bill makes it easier to plan around and use. But here's the thing, as great as these tax breaks sound, We have to look at the other side of the ledger because this bill has a price tag and it's not small. Up next, let's talk about the $3.4 trillion cost, the impact on our national debt, and what it could mean for the future of our US dollar and your financial security. So far, this all sounds great, right? Lower taxes, bigger deductions, more money in your pocket. And as a CPA, I genuinely think a lot of these changes will help everyday Americans, especially people who are working hard, raising families, or building small businesses. But here's where we need to zoom out for a minute, because none of this is free. The current estimate for this bill is around $3.4 trillion over the next 10 years. That's a trillion with a T. That's money the government will have to borrow, print, or find somewhere else because the spending side of the budget isn't going down. And we're already facing record high deficits. The US is running a structural deficit, meaning even in a good economy, we're spending way more than we're bringing in year after year. This tax bill, while popular, adds fuel to that fire. According to bar chart, the national debt is now projected to soar to over $55 trillion by 2034, just 10 years from now, largely because of this bill. That's not a conspiracy theory, that's the math. And when you add trillions in new debt without offsetting cuts, you risk undermining confidence in the dollar. And if the dollar weakens, inflation can follow. It's like getting a raise, but milk and rent prices both go up even faster. And so far this year, the dollar's on pace for its worst year in decades, driven by rising debt, runaway spending, and growing doubts about its long-term strength. And this is one reason why so many people today are turning to alternative assets, things like gold, silver, hard assets, and even Bitcoin. They see the national debt ballooning, they see the Fed boxed in, and they're asking, what happens when the bill comes due? Now, I'm not here to sell you on gold or crypto, but I do think people are wise to think outside the box and not assume things will always stay the same. The more debt we take on, the more fragile the system becomes. So yes, this bill offers some exciting tax relief, it rewards work, it helps families, and it gives business owners powerful tools to grow. But if we don't deal with the debt side of the equation, all these gains could be temporary. That's the part the headlines aren't talking about. So what do you think? Is this the tax relief Americans need, or is it a dangerous step towards even more debt and inflation? I'd love to hear your thoughts in the comments. Do these changes help you? Are you worried about the cost? Let's talk about it down below. And if you found this breakdown helpful, please do me a favor, hit that like button and subscribe for more easy to understand tax and financial insights. And share this video with someone who needs to know what's really inside this bill. And as always, thank you for being part of this community, and I'll see you in the next video.